And this was a very useful trade this past year, a couple of times using natural gas, which had some big moves, one up and one down. Conversely, to take advantage of two-way volatility or nonlinear volatility, you can actually do a short straddle, equal dollar amounts in shorting the two ETFs. Here's our contact information if you have access to Bloomberg. We do have a Bloomberg page, HETF, is our website, and then Adam and Lewis and my contact information is there as well. Okay, enough time for our lawyer. We'll just go right back to the head slide here. That's all the time they get. You pay them by the hour, so you don't want to give them a lot of time. We'll remind you, you've got question cards on your seat. We probably overlooked the fact that maybe you don't have a pen, but Kristen and Heather are running around with pens. And please write your questions out, hold them up. They will come around and collect them and get them to Tim, who will then use them to address Jeff and Dennis as we go forward. So, on to the main event. Let me introduce your moderator for you. Your moderator has over 20 years direct experience in the field of energy risk management and is now a managing director with National Bank of Canada. He leads the bank's 10-person energy risk management operation here in Calgary. His group is responsible both for client coverage on energy hedging issues and for the proprietary energy trading activities of the bank. Tim also reluctantly took over the responsibility for crafting National Bank's daily morning energy commentary 4 months ago. You probably know a little bit about that reluctance, Dennis. Doing a daily newsletter as you do. National Bank continues to be the dominant lender to the Canadian junior oil and gas community and provides lending and investment banking services to a broad segment of the upstream producer community. In 2008, we at Beta Pro Management selected National Bank to their energy desk here in Calgary specifically to provide the underlying hedge instruments backing our ETF suite of commodity products. Prior to joining National Bank in 2005, Tim was a founding principal of energy risk management consultant Risk Advisory after running the Calgary office of Bankers Trust here in the early 90s. He is a frequent speaker at industry events and has acted as an expert witness in numerous regulatory hearings regarding the risk management practices of North American utilities. Please join me in welcoming Tim Simard.
Thanks very much, Howard, and I'm honored to be representing National Bank here at the event this afternoon, and I'm very proud of our institution sponsorship role at the event as well. Howard alluded to the fact that we were selected by Horizons Beta Pro to provide the underlying hedges on the commodity ETFs, and I would say that was probably the most exciting thing that happened for our group in 2008. One of the reasons is it gives us great insight into investor flows into commodity markets, and it's quite topical, I think, for a lot of folks in this room when they're looking at energy risk management and hedging issues, what investors are doing with respect to getting plays in commodity prices through alternative vehicles. Some of you will know that I've been a long-time believer in the latent investor interest in these direct plays on commodity prices. Back in the 1990s, mid-1990s, I struggled to try and put together a structure that we could take to market that would give investors a direct play on crude oil prices, and always had difficulty finding the structure that would work. And I think the major change here over the last year is that the emergence of these ETF products now really does give investors an opportunity to get some direct price plays. And clearly the dramatic growth that we've seen, especially over the last couple of weeks, is an indication that there had been a latent desire on the part of investors for these types of products. And it's really heartening from my perspective to see the growth in these types of instruments. With respect to today's session, obviously the whole Beta Pro bull versus bear concept lends itself to a structure where we invite in two very high-profile speakers who may from time to time have slightly different views on how they perceive commodity markets and energy markets in particular unfolding over the next little while. And so it's a great pleasure to have both Jeff and Dennis on the stage here with us. I know from my constant interaction with clients that there's an intense interest in this town about where prices are going to be, not only next hour, but next week and next month. It's basically how I spend my day answering the question where prices are going to be. So I'm glad I can defer these questions to someone else for a couple hours. We've decided that the most informative way to get the issues across today is to go straight to a Q&A format. So I have some questions I will ask, but again, reiterating what Adam and Howard suggested, if you could write questions and send them up, I'd like to be able to disguise which questions are mine going forward. So it would be really helpful for me to have input from you folks. And as has been mentioned, there should be assistants on the floor to pick up your questions and bring them forward throughout the debate, throughout the discussion. So let me start by introducing Mr. Jeff Rubin directly to my right. I have the pleasure of introducing Mr. Rubin, known I'm sure to all of you as the Chief Economist and Chief Strategist at CIBC World Markets. In doing some research on Jeff yesterday, I discovered descriptive terms like maverick and rock star status. And so that suddenly explained to me why the rumors are circulating around Jeff now being recruited to speak at the next Republican Party National Convention. And I also understand he's close to signing on for the halftime show at next year's Super Bowl. Jeff has received a top analyst ranking 10 times now in Brendan Wood's annual survey, which I guess would be like Peyton Manning receiving 10 MVP awards. And that is a survey of institutional investors, and I'm sure that one of the reasons he rates as highly as he does is due in part to his entertaining and captivating performances at industry events like this one this afternoon. I've also heard through the grapevine that from time to time he has taken very aggressive views on the energy markets, including the prescient forecast back early in 2007 that crude would exceed $100. And that forecast came out, of course, a long time before it became a reality through the first 8 months of 2008. I'm sure your audience here, Jeff, is more than just a little curious as to where you believe we are heading back, when you believe we are heading back to these these triple-digit prices, and whether we're going to get there anytime soon. I am just as sure that they're growing tired of listening to this hedging guy at the mic, who often has a pessimistic view on energy markets, and are looking forward to hearing from one of Canada's best-known bullish energy commentators, Mr. Jeff Rubin. And perhaps, Jeff, you could introduce just a few comments, and then I'll go on to introduce Dennis.
Life's not linear, and neither are oil prices. Just because the world is running out of oil doesn't mean that oil prices forever go up. Because the price of anything, whether it's oil or anything else, is a function not just of supply, it's a function of demand. And of course, what we're seeing for the first time since 1983 is world demand for oil falling. Just coming after we've seen the world showing insatiable demand for oil for the previous 10 years. And of course, when world demand falls, nothing changes on the supply side, prices fall. And prices can continue to fall. But the fact that we're in a recession doesn't change the fact that every year the world loses 4 million barrels a day from depletion. And we're not losing the conventional oil. We're not losing the cheap bubbling crude that comes out of Saudi Arabia at $3 to $4 a gallon. That's what we're losing. And what we have to replace it with is really the bottom of the barrel. Oil prices can go lower. They can go to $30. They can go to $20. But as folk in this room know, oil's not going to flow. Oil's not going to flow at $20 to $40. Oil's not going to flow in the Canadian oil sands. Oil's not going to flow in the Orinoco oil sands in Venezuela. Oil's not going to flow from deep water fields in the Gulf of Mexico. Oil's not going to flow from the much-touted Tupi field off the Brazilian coast, because there's a lot easier ways of losing money than setting up a $3 billion oil sand project when WTI is 1/3 the price. And I think there's some folks who know about that. So the fact of the matter is that